you would argue that SoftBank's approach has altered market dynamics by just pouring money into these startups. And now, is this justice? Has it happened yet, or is there more to come?
I think there's probably more to come. I think the point of this is no one likes to see blood in the streets, but prices are signals. And we need a verdict on mega venture capital, which says it's excessive. And it's excessive because venture capital and investment management is becoming about raising money, not about investing. And it's excessive because lots of investors and young people are looking around for paydays and lottery tickets in a way that's distorting their choices.
What about the argument that Amazon is in effect doing this itself, but under the argument that there are so many industries that are changing massively and they have a huge war chest to pour money into those areas and dominate them if nobody else steps in to challenge it? The Sand Hill Road would say, we're doing that.
And they should be doing that, but that doesn't mean you need to do the mega venture capital model, which is writing billion-dollar checks to pretty immature companies who aren't really ready for it. And then as a consequence, the externalities to the whole ecosystem are large, which is a way of saying everyone wants to be raising a $100 billion fund, everyone wants to be writing checks, and it's all about writing checks. It's not about doing the hard work of figuring out, wait, what are the good investments? And that's the problem for all of us, and that's why we should, in fact, be rooting for something negative here.
Speaking of externalities, you could argue there have been some positive ones out of this model, right? And even Uber specifically for the consumer, for inflation.
Well, you're absolutely right. So consumers, we've been winning, right? Like, I've been loving the discounts, but it's also an unsustainable business model. It's an unviable business model. And that's not good. And it's not good because everyone starts pursuing unviable business models. And then everybody's competing on who gets funded, not on the quality of your products. And the one who's going to end up winning is not the high quality product, but it's the one with the access to the stupid money. And that is something that we don't want to see. And that kind of goes on and on and on. And you're right, Carl. I love it. And I like Uber, and I admire Uber, the company. But these larger distortions are much more important to the overall economy.
How much of this is symptomatic of monetary policy and the fact that we've been in a prolonged low interest rate environment? Because we're certainly seeing it. You can make this argument like we are today about, venture capital and tech, but you see it in other parts of the market too. For example, reinsurance rates, which are much lower than they should be given catastrophic events we've seen in recent years.
Absolutely. So this is a part of a broader picture of reaching for yield and reaching for return, because you have to go back to SoftBank's funders and you have to think to yourself, wait, what are they looking for? And the answer is they're looking for returns because they have holes in their pension funds or in their sovereign wealth funds, and they need big promises of returns. And so what's happening? People like SoftBank are willing to offer big expected returns, which are kind of irresponsible. Then people fall for it, and then we're into this cycle, and then we're going to have these kinds of distortions on and on. But I think you're absolutely right, Morgan, that the underlying reality is risk is mispriced because of artificially low rates.
So if you want to bet on this all falling apart, what's the best way to do it?
So I'm not in the betting game, John. I'm an academic.
I'm not asking you how you are doing. How would you do it?
Well, first off, I would stay away. Certainly if you're a retail investor, I would stay away. And I think you want to kind of be very kind of fundamental in this, right? So in the book that I just recently have come out with, I really try to focus on the fundamentals of finance. And that is not about chasing companies with $10 billion in operating losses. That's about real cash flow. That's about real value creation. And that's what we should all be focused on.
Do kids at HBS, do they want to do this, right? I assume they want to be Travis.
Well, you're right. There's a huge appetite for tech. And in part, that's what I'm concerned about, right? Which is the misallocation of talent. When you see all these things happening, people are like, well, I don't care how stupid the business model is, but I got a check from SoftBank. And that's not good for them, and that's not good for anybody. But, fortunately, our students are wise, and they kind of come back, and they realize that, wait a second, this is
really
kind of an
so this is turning
game.
out to be a good case study.
Well, I personally think, in response to the op-ed that I came out with, people hate to see people root for something bad because it feels negative, and I don't want to write something that's negative. But I was really surprised by how many people said, you're right, it's nasty, and it's got to stop. And so I think that's what the op-ed was trying to get at.
All right, well, the book is How Finance Works, the HBR Guide to Thinking Smart About the Numbers. Very pretty book, lots of great charts and info in here. Can't wait to dig into it. Mihir Desai, thanks for being with us.
Thanks so much.